Welcome to This Explainer. Today, we're diving straight into what is, let's be real, the ultimate financial dream, passive income. I am absolutely pumped to guide you through this material because we're going to unpack the exact blueprint you need to understand and build serious long-term wealth. I mean, we're talking about companies that literally pay you just for owning a tiny piece of them. How cool is that?
So think about this for a second. What if your investments actually paid you every single quarter, even while you're fast asleep? Imagine you chipped in to fund a wildly successful local business right down the street. In return, the owner just hands you a check every 3 months with your cut of the profits. That, right there, is exactly what a dividend is. It's a real, tangible slice of corporate earnings dropped right into your account, whether you're at work, on vacation, or literally just taking a nap.
All right, here's our wealth blueprint for today. We're going to cover 1. The passive income dream. 2. The anatomy of a great stock. 3. Top 10 dividend heavyweights. 4. Building your dividend portfolio. 5. Risks and value traps. And finally, 6. The long-term wealth marathon. Let's get right to it.
Kicking things off with Part 1, the passive income dream.
Look, when you buy a dividend stock, you're not just buying a ticker symbol. You are buying a piece of a profitable, established business that actively chooses to hand a chunk of its earnings right back to you, the shareholder. Because they provide steady income, real stability, and long-term wealth creation, they're basically the holy grail for passive income investors. It's not just about crossing your fingers and hoping a stock price arbitrarily goes up on a chart. It's about getting paid actual, real-world cash along the way, which really anchors your portfolio when things get bumpy.
Okay, let's dive into this. Part 2, the anatomy of a great stock.
So, before we look at specific companies, we need to talk about the dividend payout ratio. This is a massive key to success. Basically, it's just the percentage of a company's earnings that actually get paid out to you as dividends. Now, why does this matter so much? Well, think about it. If a company makes $100 and pays out 99 of those dollars in dividends, that leaves them with what? Practically nothing to reinvest in the business or survive a rough economic year, right? A healthy, balanced payout ratio tells us if a dividend is actually sustainable for the long haul, or if it's in grave danger of being slashed.
Now, beyond the payout ratio, there are a few other crucial metrics you absolutely have to evaluate. We're looking at the dividend yield, sure, but also the dividend growth history. Like, does the payout actually go up over time to beat inflation? We also need to see earnings consistency and strong free cash flow. But fundamentally, what we really want is a competitive advantage, or what's known as an economic moat. Think of a literal moat protecting a giant castle. It proves a company can fend off its competitors, weather those bad economic storms, and keep paying you year after year thanks to a rock-solid balance sheet.
All right, moving on to the main event. Part 3, our top 10 dividend heavyweights.
Let's start by looking at the consumer staples sector, specifically Coca-Cola, Procter & Gamble, and PepsiCo. Guys, these are absolute defensive powerhouses. Whether the economy's booming or completely crashing, people are still going to buy toothpaste, soda, and snacks, right? That fundamental human behavior translates directly to highly reliable cash flows for these businesses. Their biggest strength is decades, literally decades, of consistent dividend growth. Many in this category are actually known as dividend kings, which means they've raised their payouts for 50 straight years or more. Now, yields will definitely fluctuate, and a potential risk to keep in mind is that their massive global size can sometimes slow down overall revenue growth. But for pure defensive stability, these guys are titans.
Now, contrasting with everyday goods, let's look at healthcare and energy. Healthcare giants like Johnson & Johnson and AbbVie offer incredibly steady growth histories simply because medical needs are constant. They're totally non-negotiable for consumers. On the flip side, though, an energy giant like ExxonMobil operates in a very different reality. Exxon generates absolutely massive cash flows and often boasts much higher yields. But as an investor, you've got to be highly aware of the cyclical risks here because their success is tied directly to global oil prices.
Rounding out our heavyweights, we've got JP Morgan Chase, Realty Income, Verizon, and McDonald's. JP Morgan is just a true banking powerhouse, while Verizon offers some really significant telecommunications yields. Realty Income is actually a really cool one. They stand out because they're a real estate investment trust, or a REIT. They have a highly unique structure where they actually pay dividends monthly, which is just a fantastic advantage for regular cash flow. And then, of course, there's McDonald's, showcasing a massive dividend growth record fueled by their ridiculously profitable global franchise model.
And this brilliantly illustrates our next section. Part 4, building your dividend portfolio.
When you're putting this all together, you really have to decide on your approach. It usually comes down to high yield versus dividend growth and defensive versus cyclical. For instance, if you're a retiree and you need immediate, stable income to pay the monthly bills, you might lean heavily towards defensive stocks with higher current yields. But if you're a younger investor building wealth for the future, you're probably going to want to focus on dividend growth. These are companies that might have smaller current yields right now, but they have a proven, solid track record of rapidly increasing those payouts over the long haul.
Now, to actually manage your risk, your portfolio needs to be properly diversified across different sectors. Stuff like consumer staples, healthcare, energy, financials, REITs, and telecom. The absolute key takeaway here is avoiding dangerous concentration in just one single sector. I mean, think about it. If you put all your money in energy and global oil prices suddenly crash, your income is going to drop drastically. Diversification is, without a doubt, your ultimate shield.
Okay, let's transition into a really vital phase, protecting that wealth, because every financial journey has its hidden villains. Part 5, Risks and Value Traps.
Listen closely here, because the number one mistake beginners make is chasing unusually high dividend yields. If a stock is paying a remarkably high yield, it's very often a trap, simply because the underlying stock price has plummeted. You absolutely must watch out for high payout ratios, rising interest rates that make borrowing a lot harder for these companies, and severe business downturns. Honestly, all of these can lead to the absolute worst-case scenario, a dividend cut, and a cut will violently crush both your passive income and the stock price. So please, do not fall into a value trap just because a yield looks tempting on paper.
Which brings us to our final phase, Part 6, the long-term wealth marathon.
Enter the DRIP compounding loop. That stands for dividend reinvestment plans. I want you to think of this exactly like a snowball rolling down a huge hill, just gaining size and momentum the whole way down. Step 1, you earn a dividend. Step 2, instead of just taking that cash out and spending it, you automatically reinvest it. Step 3, that cash buys you more shares of the company. And finally, Step 4, now those brand new shares are earning their own dividends, organically accelerating your wealth. Seriously, it is absolute magic when you just sit back and let it compound over a long period.
So the crucial point is this. The best dividend stocks aren't always the ones with the highest yields. The real winners, the ones that actually build wealth, are the companies with highly sustainable earnings and decades of consistent growth. A quality business that actually has the capacity to pay shareholders sustainably for decades will always beat out those flashy, temporary yields in the long run.
And that brings us to one final question for you. Are you ready to stop sprinting and start running the long-term wealth marathon? Building a truly diversified portfolio, staying incredibly patient, and reinvesting those dividends back into quality companies. That is exactly how you create true, lasting passive income. Apply these steps, take the long-term view, and just watch your wealth compound. Thanks so much for joining me on this explainer today, and keep